Welcome back, my name is Arya. I don't waste your time, so let's get straight into it. If you guys follow me on Twitter, you would notice that in my pinned comment, I have in fact initiated a very small position in Paycom software, which is in fact going to be the topic of today's video. Paycom software is what's called a human capital management software. And essentially what that means is it's able to provide HR and payroll solutions to various businesses ranging from small to medium to even large or enterprise customers. To start us off on what exactly Paycom is and what the functionalities are, I want to read an excerpt from POLEN Capital Management, which is I believe it's a hedge fund that they manage roughly $40 billion. And they in the most recent quarter, they initiated a position just like me. I'm going to leave the link to this article below as well if you want to read the entire thing. But for today's video, we're just going to focus on the Paycom section where they say, we purchased a new position in Paycom, a payroll and human capital management HCM software company. Paycom manages payroll for over 20,000 companies that employ approximately 7 million people. It's quite a big company. It focuses on mid-market customers and holds a top 3 position as a payroll provider. So pretty much what I just mentioned here, right? So they have a lot of customers and they mostly focus on medium-sized businesses, which I think is the 50 to 500 employee range. And in that segment, they have a top 3 position behind ADP and UKG. And we're going to come back to ADP later on in the video, but apparently their software is just horrible. It's just the switching cost of ADP's been ingrained in these companies for 50 years plus, right? The company has high recurring revenues above 90% and has been adept at cross-selling HCM software to its payroll customers for years. The company has organically built a cloud-native platform where each HCM offering is tightly integrated, not patchwork of built and bought offerings like most of its peers. So a lot of buzzwords there, but long story short, they have very high recurring revenues. And what makes Paycom special is it's cloud-native. Cloud-native meaning you could open it up on a web browser compared to the ADP and UKGs of the world, whereby it's big bulky software that you have to install on a big terminal at work and it's only accessible, right? So if you're like Home Depot or something like that, you would have to install that software on a terminal at the Home Depot location, and it only works at that specific Home Depot, nowhere else. What's special about Paycom is you could open up your web browser and quickly be able to open up the terminal. They go on here to say revenue growth exceeded 20% for years before a self-inflicted wound last year caused a slowdown in cross-selling. This is really important. If you ever pull up the stock chart, which I think we pulled it up in one of the recent videos, but the stock has declined roughly 70% since the highs about 2 years ago. And this is the self-inflicted wound, right? In short, Paycom asked its customers' relations representatives to pivot their cross-selling efforts to the newer payroll offering Betty, which stands for Better Employee something something, which caused significant disruption in the company's selling motion. Management realized its mistake and it's back to its normal cross-selling activity, allowing customers to upgrade to Betty whenever ready. We expect Paycom to grow its revenues and earnings at a high teens or better rate. This is incredibly important, right? This is the entire thesis on Paycom. We expect Paycom to grow its revenues and earnings at a high teens or better rate over the next 5 years from a combination of new clients and increasing revenue per client. And honestly, that's the 2 growth vectors for any software business, right? You want to be able to sell more to the customers that you already have, and you want to sell to more customers. And that's the two different things any software company is able to grow. And they also expect that this is the method in which Paycom will be growing at. And then over here, they say that they're going to achieve this from a combination of new clients and increasing revenue per client. Both have been equal contributors to revenue in the past. Beautiful. And they actually eliminated PayPal for this, right? So they were growing very tired with PayPal, and I think 1/3 of the contributions from the PayPal sell went towards the Paycom buy. So with that established, that kind of gives you an idea as to what Paycom is and what they do. It's a payroll company, and the stock is down massively over the past roughly 3 or so years from the highs of, $550 a share, all the way down to, I think we're in the 170, 190 range at the moment. So that kind of gives you a view into the qualitative aspects of Paycom. Moving on, of course, I want to look at the fundamentals of Paycom before we move on to evaluation at the end of it. One thing to note is the CEO of Paycom in the most recent quarter, they actually gave up some stock options. And by GAAP accounting, you are actually supposed to register that as a positive impact on net income. And this is why the PE ratio looks laughably cheap. But this isn't actually true. This is a flaw. This isn't technically actual income that is registered for the business. But anyways, just something to note about that. The PE ratio is skewed. This is one of the reasons why I hate the PE ratio, right? But anyways, moving on. As you guys see, Paycom has a tremendous history of just being able to grow revenues massively over time. Same thing goes for net income. Same thing goes for free cash flow, right? If we were to just flick this onto free cash flow, you'd be able to see every single year, like clockwork, the free cash flow ticks higher and higher. One thing to note, and this actually came in a conversation that I had with a friend, the free cash flow of Paycom is a little bit handicapped by the tremendous amount of capital expenditures that they're doing, right? They're building out all these new office buildings and all that type of stuff. And how we know this is we could see that the discrepancy of operating cash flow to free cash flow is massively, they're very different, right? It's roughly about 60%, maybe 50% of the operating cash flow line. So this is a lot of capital expenditures that the company is doing that I don't think it will continue out maybe 5-10 years from now when the company becomes more mature. If we were to compare to a similar company, also a software company that's in my portfolio, Salesforce, you would see that the operating cash flows and the cash flows of the company are almost in line. Salesforce, which is a very mature software business, doesn't do that much capital expenditures. They're not out there building new office buildings or buying new computers, and right, they don't have much capital expenditures into hard assets for the company. Anyways, going back to Paycom, couple quick facts about the business. The gross margins are absolutely incredible. 81% gross margins. That means that it roughly costs the company $19 to create $100 in revenue. To give you an idea, the S&P 500 is roughly in the 35% range. So massively above the S&P 500. Return on invested capital, 51%. Again, S&P 500, roughly in the 10 to 15% ballpark. PE ratio, of course, 12. We mentioned that this is a little bit inaccurate and a little bit misleading because of the recent stock options that the CEO gave up. So jumping over to free cash flow, you would see that it's roughly trading at 37 times trailing free cash flow. Also, one other thing that I wanted to sneak in here that the POLEN capital management guys, they talked about, they said 90% plus recurring revenue. It more looks like 99% because they had recurring revenues of 1.7 billion and total revenues of 1.74 billion. So that's almost all of it except for this 30 million line, which is implementation and other revenue, right? So maybe Paycom charges some businesses to implement their software into their whole workflow and all that type of stuff. That's the revenues generated from that. That's like a one-time thing. Other than that, everything else is recurring revenue. Moving on, one last thing that I wanted to mention is, in fact, the valuation of the company. As you could see, Paycom in the past 5 years has traded all the way up to a 200 PE in November of 2021. This is at the peak when I was at like 550 a share. And then now we're looking at roughly 22 times GAAP PE. Again, I'm going to remind you that this is in actuality closer to maybe 30, but even with 30, you could see that's like below the COVID bottom on this company. In fact, this company has never traded below a 40 PE until the past couple months. So you are really getting this at a bargain price compared to its historical especially. But again, the historical is a little bit skewed because it was overvalued for so long and it was growing at a much faster rate. Nonetheless, I think it poses as excellent value as it stands currently. At last, I want to jump over to my free cash flow to growth spreadsheet that I include in every single one of my videos. You guys know the drill at this point. It's very similar to the PEG ratio. Essentially, we divided the current valuation of the company by how fast we expect the company to grow at. So in the case of Paycom over here, again, I'm going to remind you that the free cash flows are a little bit messy, but nonetheless, you take 37 times price to free cash flow, and I divide that by roughly 14% growth rate, which I think is more than achievable, right? POLEN Capital expects revenues to be growing in the high teens range. So I'm saying, you know what, maybe they do a little bit more capital expenditures, and the free cash flow of the company actually grows a little bit slower than that. So you take 37 divided by 14, you land at roughly 2.7 times the growth rate. Now, why did I initiate a position if it doesn't rank in the undervalued range for my companies? To answer that question, I'm going to jump over to another tweet that I put out where I talked about how there's many ways of valuing businesses and there isn't one size fits all. And depending on the maturity of the business, you may want to value companies differently. And in the case of Paycom, because they're actually investing a lot into building out all these different office buildings and all that type of stuff, I think free cash flow is a little bit handicapped and it doesn't tell the full story. While on the other hand, if you look at the PE ratio of the company, and of course we're adjusting it for the stock options that the CEO gave up, you're looking at roughly 30 times PE for, let's just say, maybe 15 to a little bit more than that EPS growth. So I think looking at it on that front, it looks better. And I think it's a better representation of how the business is actually going to be growing out into the future. And again, I'm going to refer you to this chart that Brian Feroli actually came up with. And I think Paycom is roughly in this 3 entering the 4th stage of the business. And this is an area where the free cash flow isn't too optimized. And maybe the PE ratio is actually able to tell a better story. With that being said, I'm curious to know what you guys think of Paycom. Of course, I did in fact initiate a tiny little position. I'm thinking of maybe bumping it up to like the 4% range. As you guys might notice, the 4% range is where all my small holdings are. I did get roughly 7% more cash into the portfolio, just purely based off deposits. So yeah, I'm thinking of where to put that. Feel free to chime in on what you think of Paycom in the comment section down below. I'm always curious to see what you guys have to say, and I read every single comment and respond to every single comment always. With that being said, I'd like to ask you to do something that costs you nothing, but would help me out greatly. If you could hit the subscribe button, I'm going to continue posting high quality videos just like this one, and you could always go back on that decision if you end up not enjoying the videos, but I highly doubt that. Thank you for watching. Have a great day.